Top economist Mark Zandi has issued his starkest warning yet. The U.S. economy faces a 48% chance of recession in the next year. From collapsing housing permits to a fragile Federal Reserve decision, here's the full story of why the cliff's edge feels closer than ever. Mark Zandi was no stranger to economic headlines. As the chief economist of Moody's Analytics, his name appeared often in newspapers, reports, and on television. But there was something different in his tone this time. It was sharper, more urgent. He was not just analyzing data, he was issuing a warning. When he told an interviewer the United States economy was on the precipice of recession, the phrase landed like a thunderclap. Traders, policymakers, and journalists all leaned closer. If Zandi was worried, they knew it was serious. The timing of his words mattered. Inflation had rattled households. Interest rates were at levels not seen in years, and consumer confidence was fragile. Every grocery bill, every car loan, every mortgage payment felt heavier to ordinary families. Businesses were cutting back on hiring, and whispers of layoffs crept through corporate corridors. It was an uneasy calm, like a city waiting for a storm. In that climate, Zandi's phrase, "edge of a cliff," did not sound like exaggeration. It felt like the truth many people were already sensing but had not yet spoken aloud. Zandi had built a reputation on calling risks before they became obvious. During the financial crisis of 2008, he was one of the analysts who warned about the dangers of the housing bubble when others were still optimistic. That memory gave his words even more weight now. When he spoke of danger, the world remembered that he had been right before. So when he described recession odds as uncomfortably high, people did not brush it off as noise. The phrase spread across financial television, headlines, and social media feeds. Everyone wanted to know, what made him so alarmed this time? Investors reacted quickly. Some shifted portfolios toward safer assets. Gold ticked upward, bond yields flickered, and cautious voices began to dominate trading floors. But outside Wall Street, the effect was just as powerful. At kitchen tables across America, families talked about job security and shrinking savings. For workers who had lived through 2008, the echoes were unmistakable. The tension was not just about numbers. It was about trust. If the man at Moody's was warning of a cliff, how long could the economy balance there before slipping? At that moment, no collapse had happened yet. The markets were still open, the lights were still on, and business continued. But Zandi's words hung in the air like a shadow over everything else. He had pointed at the cliff's edge and said the nation was too close for comfort. Few knew exactly what the next weeks or months would bring, but everyone felt it. The uneasy silence before a storm, the weight of a warning that could not be ignored. The alarm bell had been rung, and the sound was echoing through boardrooms, factories, and households alike. When Mark Zandi explained why he was so alarmed, he pointed not to Wall Street or stock tickers, but to something quieter, building permits. To most people, permits sound dull, a bureaucratic detail buried in paperwork. But to economists, they are one of the most reliable signals of what comes next. When builders stop asking for permits, it means they are pulling back on future projects. And when construction slows, it ripples across the economy. Fewer jobs, fewer materials ordered, less demand for furniture, appliances, and cars. Zandi held up the numbers. They were not just slipping. They were falling fast, approaching lows not seen since the pandemic lockdowns. Behind those numbers were stories of hesitation. Across the country, developers were halting projects mid-plan. Empty lots sat fenced off, with bulldozers idle. Buyers were vanishing, spooked by high mortgage rates and rising costs. Realtors reported open houses with no visitors. Builders who once rushed to pour foundations now sat on the sidelines, afraid of being stuck with homes nobody wanted. Zandi described it as a freeze. Supply and demand were locked in a standoff. Unsold homes stacked up like dominoes waiting to fall. The imbalance signaled that confidence, the lifeblood of the housing market, was evaporating. For Zandi, the housing signal was haunting. He reminded people that housing downturns had preceded almost every modern recession. The Great Recession of 2008 was the most brutal example, triggered by a housing bubble bursting. While today's situation was not identical, the pattern was too familiar to ignore. He pointed to charts showing past cycles. Each time building permits collapsed, a recession followed within months. The economy is fragile, he said. When housing slows like this, history is clear about what comes next. The warning was not just academic. It was a reminder of pain people still carried from crises past. What made the moment even more tense was timing. The new housing permit data was being released just days before the Federal Reserve's meeting. Analysts knew that policymakers would see the same red flags Zandi was describing. The debate was no longer abstract. The numbers would force the Fed's hand, and the world was waiting to see how they would respond. Investors circled dates on calendars. Journalists wrote that Wednesday's report could make or break the markets. Zandi predicted openly that the Fed would have to cut rates. But even he admitted, grimly, that it might not be enough. For families outside the financial world, the news filtered down in simpler terms. Headlines screamed about permits collapsing, buyers disappearing, and economists warning of recession. People driving past half-finished housing projects felt a pit in their stomach. If homes were not selling, what did that say about the broader economy? For investors, the data felt like a flashing red light on the dashboard of a car speeding downhill. You could not ignore it. For workers, it felt like a quiet signal that jobs might be next. For Zandi, it was confirmation of what he had already sensed. The United States was moving closer to the cliff's edge, and the ground beneath it was cracking. On a quiet weekend, Mark Zandi opened his account on X and posted a figure that would ripple across the financial world. He wrote that the chance of a United States recession within the next 12 months was 48%. It was not a prediction of certainty, but the number was high enough to send chills. For context, recession probabilities rarely rise above 30%, even in uneasy times. 48 was not just unusual, it was historic. He added something darker. Never before had the probability reached that level without a recession following soon after. It was not quite half, but it was close enough to feel inevitable. Analysts compared the number to a coin flip. Imagine tossing a quarter in the air with nearly even odds that it lands on recession. It did not matter that the technical number was less than 50. Psychologically, it felt like a line had been crossed. Investors hate uncertainty, and Zandi had just declared that the next year was essentially a gamble with enormous stakes. Television anchors repeated the statistic. Newspapers put it in bold headlines. The words "uncomfortably high" trended across financial Twitter. Everyone was asking the same question. Was this the final warning before the fall? On Monday morning, traders arrived to buzzing screens. Futures dipped, bonds rallied, and gold ticked upward as investors rushed towards safety. Hedge funds debated strategies behind closed doors. Some believed Zandi was being cautious, but others quietly rebalanced portfolios. They had seen enough downturns to know that ignoring signals could be fatal. Financial television played his interview clips in loops, showing him warning again that the economy was at the edge of a cliff. Markets listened because he had credibility. The number 48% carried the weight of years of data and a man known for not exaggerating. The impact went beyond investors. At dinner tables across America, the statistic filtered into conversations. A mother in Ohio asked her husband if they should delay buying a new car. A worker in Texas wondered if his company would freeze hiring. Families remembered 2008 and feared losing jobs or homes again. For ordinary people, Zandi's words turned into an unease that hung over daily life. Even those who did not follow economics directly could feel the anxiety. News segments broke down the number in simple language. 48% was not abstract. It meant almost 1 in 2 chances of economic pain arriving soon. For Zandi, it was about honesty. He wanted people to see the risk clearly before it was too late. But his statement also had an unintended effect. By warning so strongly, he may have deepened the very fear that could trigger the downturn. Confidence drives economies, and once shaken, it can spiral quickly. The number lingered like a storm forecast that everyone checks, but no one can stop. Markets knew it. Families knew it. Policymakers knew it. 48% was not just a figure in a report. It was a line in the sand, a warning that history rarely ignored. As the week unfolded, Zandi's warning became the backdrop to a bigger event. The Federal Reserve was scheduled to meet. For months, the Fed had been raising interest rates to fight inflation. But higher borrowing costs were already choking the housing market and squeezing businesses. Now, with building permits collapsing and Zandi's 48% warning echoing through the headlines, the stakes were higher than ever. Investors, bankers, and politicians all asked the same question. Would the Fed cut rates? Could they act quickly enough to stop the slide, or would they hesitate and push the economy over the edge? The Fed was trapped between two dangers. Cutting rates could calm markets and give businesses breathing room. But cutting too soon could reignite inflation, undoing months of painful progress. Keeping rates high, on the other hand, could crush demand further, turning a slowdown into a full-blown recession. Economists called it a no-win scenario. Whatever choice they made would carry risks. Zandi weighed in publicly, saying the Fed had no choice but to cut, but warning at the same time that even a cut might not be enough. His words spread across television banners. Rate cut cannot stop recession. The tension built as Wednesday approached. Financial journalists compared it to waiting for a verdict in a trial. Stock markets held their breath. Analysts dissected every phrase from Fed officials and past speeches, looking for clues. Ordinary people who rarely paid attention to interest rates suddenly found themselves curious. Homeowners wondered if mortgages would ease. Students questioned what would happen to loan rates. Small business owners checked their bank accounts nervously, wondering if credit would stay affordable or dry up entirely. The entire nation was waiting for the same group of officials in Washington to speak a few words that could ripple across every household. On Wall Street, traders crowded in front of screens, watching futures swing wildly with every rumor. Some funds quietly bought gold and bonds, hedging for safety. Others gambled on stocks bouncing back if the Fed cut aggressively. In interviews, Zandi kept repeating his grim message. Even if they cut, the fundamentals are weakening. Housing is flashing red. Confidence is draining. The Fed can ease the pain, but they cannot erase the problem. His voice carried the same mix of authority and doom, reinforcing the sense that the country was running out of time. The night before the announcement, newsrooms buzzed. Television anchors promised live coverage of the Fed decision. Newspapers prepared headlines for both scenarios: Fed cuts to avoid recession, or Fed holds steady as risks rise. It felt like history was about to pivot on a single moment. For the millions of people watching, it was not just about markets. It was about jobs, paychecks, and savings. For Zandi, the message was clear. Whatever the Fed decided, the risk of recession was already uncomfortably high. The country was not waiting for the storm to begin. The storm had already started. As markets opened the next day, the mood was fragile. Traders stared at screens that flickered between red and green, each shift carrying the weight of billions of dollars. The nation was waiting for the Fed's announcement, but the real tension was psychological. People were already acting as if recession had arrived. Businesses delayed expansions. Families postponed car purchases and vacations. Investors clutched at safe assets. Zandi's number, 48%, echoed like a drumbeat. Not certain, not inevitable, but close enough to make every choice feel dangerous. Across the country, small signs of slowdown appeared. A factory in Michigan quietly trimmed shifts. A tech company in California announced a hiring freeze. A retailer in New York hinted at cutting staff hours. None of these made national headlines, but together they formed a chilling pattern. Workers whispered nervously in break rooms, asking if their company would be next. For many, the economy was no longer an abstract concept. It was personal, tied to paychecks and bills. The sense of walking on a tightrope grew heavier each day. When the Federal Reserve finally made its announcement, the world leaned in. The Fed opted for a modest rate cut, signaling they were aware of the risks but unwilling to fully abandon their inflation fight. For a moment, markets surged in relief, then dipped again as investors realized what Zandi had warned. A cut might soften the blow, but it would not erase the danger. Commentators filled the airwaves with debates. Was the Fed too cautious or too late? Everyone seemed to agree on one thing: the cliff edge had not moved. America was still standing on it. On social media, the public conversation shifted into fear and sarcasm. Memes about flipping a coin for recession spread widely. Hashtags like #RecessionWatch trended. At coffee shops, people debated whether to refinance mortgages or hold cash. College graduates worried about entering a job market that could collapse at any moment. The economy was not yet in recession, but the mood felt as if it already was. Fear itself was becoming a force, shaping behavior in ways that could accelerate the downturn. Zandi's words lingered as a final warning. The probability has never reached this level without a recession following. It was not a prophecy, but it was a fact rooted in history. Families, investors, and leaders all carried it with them as they looked to the months ahead. The United States had not fallen yet, but it was leaning dangerously forward. Every new data release, every market shift, every company report would feel like a gust of wind. The cliff's edge was beneath everyone's feet, and the question remained unanswered. Would this time be different, or would history once again prove that the fall was unavoidable? This is the end of that story. Now tell me in the comments, what's your most unbelievable story? I'll read out the funniest ones in the next video. Do not forget to hit a like button and subscribe. See you.